Good morning, thanks for tuning in. Well, the local share market's going to take another decent knock at the start of the session. This morning, the futures are predicting that the ASX 200 will be down by a little less than 1%. The contract finished down by 68 points, or about 0.94%. I suppose the encouraging aspect of that is that the contract was off its worst levels of the overnight session when it was down by about 1.5%. And that's the same that can be said for US markets, having withstood quite a barrage of selling. For example, at one stage, the Dow was suffering its worst points loss since October of last year, when it was down by close to 1,000 points. It recovered to be down by 725 points. So it wasn't a bad outcome compared to the worst levels of the session. It was still down by about 2%. The bottom line here is that you are seeing these markets retreat rather aggressively from their recent record highs. That's an important bit of context to keep in mind when you're hearing some rather breathless reporting around the extremities of this sell-off at the moment. And there's another probably more important aspect to this piece as well. It was only weeks ago that we were talking about inflationary concerns. Now we have pivoted very quickly towards a moderating growth picture. And that can be reflected most acutely when it comes to long-term interest rate settings. So we have seen a big fall in long-term interest rates over the course of the last couple of months, falling from around 1.75% back to around 1.18%. So in bond language, that is a big rally in bond yields, higher in price, lower in yield. What it very clearly tells us is that growth expectations have changed dramatically over the course of that period. And given this, that you've seen the sharpness of that rally, that has brought stocks undone to an extent. They are worried about what they're seeing with these bond prices or bond yields, which are telling us that growth is going to slow. And that is why you're seeing this adjustment in terms of share prices. So it's just a question of whether or not things can consolidate in the near term. And that's a really important consideration, because whilst we have seen growth expectations chisel in quite aggressively, so too now are going to be expectations around what central banks are going to do. A couple of months ago, there was a rather feverish conversation about bond purchases being tapered, rate increases happening sooner rather than later. The most recent outbreak of the pandemic as it relates to the Delta variant necessarily means that central banks are going to be a lot more cautious in any pronouncements about tapering their bond buying programs or any adjustments when it comes to their settings more broadly. What that means is more support for longer, and that's going to be a self-correcting mechanism for these stock markets at some time. They will get to grips with the fact that interest rates are going to be lower for a longer period of time, and that will be an automatic stabilizer of sorts. It's just a bit difficult to work out when that automatic stabilization process kicks in, because there will be there might be a little bit of volatility in that intervening period. But the other thing that stands out last night is the big fall in energy prices. So again, this is another proxy for growth expectations, as we were talking about with bond yields. So when you see oil prices fall by about 9% in a session, that is certainly something to pay attention to. They actually recovered off their worst levels when to finish down by around 7%, but still it's something to bear in mind. Growth expectations have changed quite quickly. They'll change again, but for the moment we'll see a fair bit of volatility. So banks are going to be affected today as well with those falling bond yields. Their margins are going to be under quite a bit of pressure, so keep that in mind. Elsewhere, the transport-related stocks were marked down quite heavily in the US. Airline stocks were down in the order of around 5% in terms of some of the leading names. The other probably more positive thing is that for the moment at least, we have seen iron ore prices hold up. So last night, in the last day, they were down by about 1%. You would think that they perhaps might be down a little bit more than that under the circumstances, but there's an important reason why they're not. Chinese steel prices are in the neighbourhood of record highs. So what that means is that the margins that steel mills enjoy are still reasonably healthy. As long as that's the case, then there'll be a pretty solid demand for port stocks and the like. That's one of the factors that is helping iron ore prices out at the moment. So what we saw in currency land overnight is that most currencies lost ground against the US dollar, which is kind of understandable under these circumstances. The Aussie dollar wasn't left out, so it's fallen back to around 73.4 US cents.